So this is a disease that I found out back in 2007, 2008. And so in order to open up, first of all, I'd like to say thank you very much to Ian Amro for allowing me to torture you for 35 minutes. And then I'm going to go through a little bit about the story of how this disease was found and then also the cure. But in order to warm myself up and also warm up you guys, I thought I'd tell you how I got into this industry. And so if you're worried about this weird accent that I have, it's because I'm from Albuquerque, New Mexico. And I went to military school and wanted to get as far away from military school as possible. And so went over to Paris, France, where they had a dual sort of program to where I could speak English and French and have an education, God forbid. And I wanted to be this guy with $500 of traveler's checks and a passport and go and solve labor disputes in Italy after I got out. And I had an accounting teacher, and her name was Kate Carpenter, and her husband was that had soybean trading at the CBOT. And after she told me a whole bunch of stories, I said, screw labor strikes in Italy, this is what I want to do. I want to go over to the Board of Trade. And the thing was that I had no connections. And me being an American with no experience in France, I couldn't go and get a job in France in the financial markets. And so I went over to New York and had a couple of appointments there. And was there for about a week or a week and a half. And then I went over to Chicago, had nothing there. No appointments. How do I get into this big building, this massive trading floor? And I thought, well, traders like to drink. So why don't I go to a bar and see if I can get a job there? But it just can't be any bar. And if you know Chicago, there's a bar right in the Chicago Board of Trade called Ceres. And I thought, well, that's too obvious. Because, when the boss walks in, he's going to see his employees drinking, and that's just not going to happen. It has to be a bar that's kind of close by, but a little bit more inconspicuous. And so there was a place called the Brokers inside the Insurance Exchange, just right next door to the Chicago Board of Trade. And there I came in, I had 3 days to go, I came in at 3 o'clock, and it was kind of empty except for the brokers who would be there for, their fifth vodka cram. And so I missed it. And so I came in, because the grain floor closes at 1:30 or 1:15, the bond floor closes at 2. So next day, rock up, after lunch, 1:15, the traders start coming in, and they say, okay, I started asking these old traders, how do you get a job at the Board of Trade? And it's like, okay, you don't want it, you don't want to be in this business. And then I was like, okay, fine. Then I met a guy named Terry Byrne, and he was working for Dean Witter, which kind of shows you my age. And Terry, so I asked Terry the same question, how do you get a job at the Board of Trade? He was like, well, you got to become a runner. I said, okay, great, well, how do I become a runner? He was like, well, you got to go talk to Bobby. And so I was like, okay, well, where's Bobby? He's like, hey, Bobby, you still looking for a runner? I was like, yeah, bring him over. And then that was how I started the business, is, trying to be a little bit enterprising to the thing. So started as a runner, then came in, worked my way up to Car Futures. Now it's SocGen, it used to be Calion. I think we share some of the alumni in the audience. And anyways, we were working with some of the best CTA, systematic trading funds in the business. And by that time, I kind of started to get a little bit of a better idea of how this industry works. And I didn't want to be the monkey who would, pick up the phone, get an order, and repeat that very same order in the other phone. I wanted to be the guy to make the decisions. I wanted to be this guy. Anybody who knows who this is? Yeah, Crispin Odie. And actually, one of my colleagues was the CEO for Crispin for a long time, and always appreciated his brand of fund management. And the thing is that and so I went in, and I eventually got a job at SocGen, and after my MBA, that's kind of how I got into this business of this wonderful world of asset management. And so the thing is that when it came time, I worked at SocGen, managed a credit portfolio, then went over to Nordea, managed the equity vol portfolio. And when it came time to sort of get the feeling that, hey, I need to go out and start my own firm, I had a whole bunch of ideas about the business side of asset management. Because if you look at the asset management as a business, there's a big difference between this guy, who was a good fund manager, and this guy, who was successful. I don't know who he is, by the way. Um, but in that formula is AUM times management fee plus performance fee. That to me is success. And that means building a proper business. And so my timing was really, was great. The strategy I wanted to launch was called an event-driven equity, a long volatility strategy. Think about it, negative correlations to the equity markets, long convexity, and and positive drift, golden goose, right? But I also had some very definite ideas on how I wanted things to happen. And so my timing for the strategy, which was 2007, 2008, was great. But the timing to open a business was bad, was very bad. You know, I was like an insurer who was trying to work on, or trying to insure people's cars who's already been wrecked. And so, so you know, I went on my own and set up a company called Perfecta Partners, which was a sort of a management consulting firm for asset managers. And it was based on all these ideas that I had about, you know, the business side of asset management. But this is when I discovered my issue. This is my disease. Is I had maybe the Nordea SocGen sort of issue to where, you know, if I was going to go and meet with an allocator or meet with somebody, I could give you my SocGen card or my Nordea card, and people knew who I am or who I was. And now I come up with this card, Perfecta Partners. Nobody knows who the hell this is. It's not important. And this is when I started to figure out that, you know, first of all, I was suffering from the, you know, SocGen disease, but then also the fund manager disease, because I thought I was so important, so special, and now I actually have to deliver real value to people, and that's the problem. So, now comes time to actually take a look at this industry and figure out, okay, well, what is going on? And so, when I started in the industry, it was in the mid-90s. There were a couple hundred hedge funds, maybe a couple thousand investors, and you know, you could probably get around to them and you know, and try to get some allocations. Today, we estimate that there are 13,000 to 14,000 hedge funds out there. About 30,000 allocators that will allocate to any one single hedge fund. To put that into perspective, you're looking at 74 to 75,000 long-only vehicles. There are more funds, I was told, than equities. Okay? And if you're looking at hedge funds, are they so special? Well, if you take the total amount of assets that are dedicated to long-only vehicles, and then assume that there's $2.5 trillion that are dedicated to hedge funds, that makes it roughly around 13 to 15%. So this is no longer a niche. And herein lies the problem. Another issue that we find, and I love this chart. I've sort of, this has been my nightmare for about 5 years, is that we're looking at the distribution of industry assets by number of firms. And so this is by HFR, I think. Their number is 62%. 62% of all the firms are under 100 million. And if you look at Clayton's example about how much it costs to run a fund, you know, the average fund being 10 people, maybe a little less, by the time you finish with all the expensive rents, if you're in Mayfair, God forbid. And then also you're paying Bloombergs and all this other stuff. If you have $100 million in your AUM, and let's assume that you're lucky enough to get 2%, do you have a business? And then we're looking at distribution of industry assets by firm AUM. And those guys under 100 million control 8%. How many of you guys have seen this chart? Raise your hands. So we're looking at this, and we're seeing that 100 million controls 8% of the industry, and then we have $1 billion, a $1 billion club control 60%. And that scared me. I was really worried about that. But, you know, at the same time, you know, you can think about it, the industry averages, if you want to look at performance, for example, half the industry by magic, arithmetics, are below, you know, are below average. And then you have the people who didn't understand the business side of asset management. You have the people who are running funds as sort of like a family office or a lifestyle venture. I didn't want that. And then you also kind of think of, okay, well, is this normal? And actually, it totally is. If you look at the long-only or the U.S. mutual fund markets, the top 25 asset management firms control 74% of the industry. So, you know, you have a lot of people who are trying to become the big guys, and then, you know, you have a lot of people who are not going to give up their position. So, let's see what's really going on. We're in Amsterdam. Couldn't think about a lot of industries, but I do know tulips grow here. And so, you know, a lot of the things that we kind of suffer with in the asset management world are actually not all that complicated. You know, you look at when you start to look at small business, you start to understand some of the challenges that people have. And so, when you're setting up a flower shop, what are you looking for? What are the drivers to succeed? Well, in this example, you're probably looking at what other people sell tulips in the area. What's the foot traffic like? What kind of product are you going to deliver? Are you going to deliver fresh tulips just out of the field? Or are you going to do the day-old ones and sell them for a cheaper price? Are you hooked up to things like Interflora? You know, all this sort of stuff. And so, a couple questions to think about, you know, in the asset management world. Some of these are going to overlap with a little bit later, so please bear with me. It goes also back to a little bit of what Clayton says. How do businesses succeed? And what you have to do is you do have to ask yourself, what am I offering to allocators that they can't get elsewhere? Okay, you can be the best Japanese warrant trader in the world, and you still have to ask yourself, what was it? What is it that I'm offering? Being small is not such a bad thing. You know, being the $3 billion long short funds, not bad either, but they can't move as quick as you can. So you have to sort of ask yourself the very simple question. Then you have to hire the right people. Have to hire people that you actually trust. And this is actually quite important. You know, we often times hear in business discussions that my business is like an extended family of mine. It is not an extended family. It's a team, okay? And people get cut from teams. People are rewarded from teams. If you try to hire your idiot brother to manage your business, and he just comes from, I don't know, just take your pick. I won't sort of target any one person. You have to sort of ask yourself, is that the right decision for me? And businesses don't love you back. Funds don't love you back. Then also, it goes back to a little bit of what Clayton says, what is the size of the opportunity? You know, the one thing that we also do actually is we also ask, you know, who are your competitors? You know, because if you don't know and you think you're unique, then we have to ask some serious questions on whether people really know what what's going on in the business side. Not only that, but it's also not bad to be a niche fund. You know, but you have to know who buys your fund. And oftentimes it's the allocator who can tell you. A good example of this is actually in UCITS. And I just thought about this chart, and of course forgot to put it in. And essentially, you know, if you look at the UCITS world, the UCITS has a lot of European equity long short. There's also a few sort of US equity long short funds, macro funds. But if you look at sort of like the absolute return UCITS world, there are very few funds in some of the more niche categories. And so if somebody's looking to build a portfolio, you're going to get a look anyway, just because you're one of the only ones out there. And so you're trying to match the opportunity set with the proper size. If your capacity for the fund is 50 million, well, you're probably not going to become the next Fidelity, and you have to ask yourself if you want to be in that business. You know, if the math works out. And then, who do you compete against? Again, going back to Clayton, if an allocator is going to look at you, they're going to go back to work and say, okay, well, what are they offering that I can't get elsewhere? You should know that, and also know ways to know how you compete. Once you can compare, you know how to compete. Now, this is really my pet peeve. I can't tell you how many times I've come across this, is not people not having enough working capital. I've known people literally to set up $1 million funds, $1 million businesses, spend $1 million on the prospectus and all the other things, not including their time and all that other stuff. And their net worth is $11 million. They put $1 million into the structure, put $10 million into their own fund, and then they say, oh, well, we don't have any money to hire salespeople. We don't have any money to spend a little bit of sort of targeting, segmenting. We don't have enough money for Murano. It's bad. And so, you know, you gotta run this like a business. You know, it costs money to make money. It costs money to get sales. You know, there's a lot of things that are going on around this. And you know, can you imagine that poor girl with buying a whole bunch of tulips and putting them in her basement because she thought everybody will know she has the best tulips? No. It doesn't work like this for in the asset management industry either. Then we also see a lot of these issues where the funds aren't really properly structured, where, you know, there's, you know, this can be a little bit frustrating, but again, this is all about market research and talking to the right people. I mean, how many times have you seen, you know, funds that, you know, have been structured to where they provide weekly liquidity and usage space, you know, when most allocators want daily, you know, the rates being too high, the liquidity not matching the underlying asset class. And we've seen it both ways. We've seen it to where people have yearly locks on, you know, mid-cap equity funds, and we've seen others to where they've had monthly locks on very illiquid sort of consumer loan funds. And so if the assets don't match the underlying asset class, there's usually a big issue. And the way you solve it is just go do some research, go talk to allocators, find out what they want. You know, find out what a good structure is. And so here we're coming up with a cure. So we know what the problems are. And the biggest part of this cure is this, and do not ever forget this. You are your own agency issue if you're an asset manager, if you're the fund manager. And the reason why you're your own agency issue is because if the product guy also has to run the company, typically they can only do one or the other. It's in many ways, I mean, you know, you think about it, it's unfortunate because the CIO, i.e. the great product person, has to run a business, and he thinks a lot of it from a product perspective. And so you have a big disconnect from somebody who's actually committing capital to run the business. And very few times do you see to where you actually have the owner of the business and or is sort of as an equal share or even more than the fund manager. And when you talk to Fidelity or Schroders or all these other people who are running like asset management companies, this becomes obvious to where this segmentation of both the manager and the business side are two very separate things. Let's see. So the other thing is judge yourself by the same standards that you judge others. And oftentimes, you know, you get this, especially when you're talking to equity managers that are fundamental. You know, if you're an equity, you judge things like, you know, revenue growth, profit margin, all these sort of things. What makes great companies? And then you look at your own firm, and do you share that same profit margin? Do you share that same revenue growth? Why are you failing with your companies that you decide to put in your portfolio are succeeding? And once you know that, the gloves are off, right? Because then it's a little bit liberating to find out, okay, let's see how to get these things moving again. And then also, hire the proper people. You know, and this goes back to, to the original bit, is that in order to have a successful business, you have to do three things, okay? You have to have a great product, you have to have somebody who can sell it, and then you have to have somebody else who can run the money. And nobody ever can do three things correctly. They might be able to do two, but never three. And so you need to ask yourself, am I good at marketing this fund? No, find somebody else. Do I have time to work through the out trades and through the compliance issues and whatnot? No, fine, hire somebody else. Focus on the product. If you're good at the sales, and some people are, do the sales as well, but just make sure you're structured around what your strengths are and what your weaknesses are. And also don't be afraid to pay people, you know, at least what they're worth, or a good base and incentive, whatever. Just make sure that it's working. We see this mistake time and time again. Performance. So performance is not as important as I once thought. We come across a lot of asset managers who think that if they yield 20% day in, day out, or year in, year out, I should say, then people will come to them. And that's not the case. And then, this is also the thing that I worry about with, about everything. I mean, if you look at it, the allocators and the investors have some very similar issues. If you're a fund manager and you're saying, well, Google's performed really well over the past 3 years, I'm just going to buy Google, literally allocating with the rearview mirror. If you're a good fund manager, I'd be surprised everybody's kind of lucky, but usually that's not the way it works. What you're looking for is you're looking for drivers of why Google will continue to be profitable in the future. And this is not all that different from allocators. I mean, you look at allocators, the fact that you perform very well is only one aspect. And as a fund manager, you look at a lot of bets and you start to think that, okay, well actually, I have very similar bets, but in different markets. So if I'm bearish, equities, I might have the same play in the currency market, in the rates market. And then I think, oh wow, actually, my bets are correlated. And so this is one issue for allocators. I've heard about it. I can't put a number. It'd be great to put to get like a little questionnaire going forward. Is like, how important is performance and all the factors that come around, investing in a fund. The number I kind of hear often is about 20%, because there's everything else. I mean, another way is that if you are a fund selector and you see a whole bunch of charts, just charts, and hopefully these charts are all kind of going up, then you can ask yourself, okay, well, how am I going to build a portfolio? What are the other things that I need? Are they going to? Is my money safe? Is there the right people? Are there the right people that are given responsibility? All this sort of stuff. And so don't think that just because you have good performance, everybody's going to rush to you. And actually, if you have good performance and you're stale over years, then people are going to ask themselves some questions on why that is. Because one of the bad things is that if you can be an emerging manager, there's nothing wrong with that. Are you going to be here in the next 3 to 5 years? This is important also. Think of any business in the world to where people will give you something for free and it makes you rich. Okay. Third-party marketing, where you say, oh great, it's a free option because if they bring in anything, I just pay them 20% and it's free. It isn't free. And the world has changed quite a bit. To where the sales cycles right now in hedge funds we're seeing are 6 to 9 months long. There's not a lot of people who will just say, you're so great, I'm going to work for free for you until you get some assets. And you kind of have to worry about the 3PM is willing to do that. I'm not saying that third-party marketing is bad or that it's not working, but it has to work under the right consequences. And then if you're paying a retainer, you also have to ask yourself, well, should I just hire somebody dedicated in that house who can properly represent my brand? It also is not blanket. It might not work in hedge funds, but it doesn't mean third-party marketing doesn't work in private equity or in some spaces along the way. But you have to ask yourself some very serious questions. What's so good about my product that somebody's just going to do it for nothing? Cap intro teams. Cap intro teams are wonderful, but they're not there to build your business. You have to build your business. They're here to help. And so, just don't expect to sit around and be brilliant and wait for the money to come in. And stay humble. It's funny because if you manage money or if you've been in this industry for a while, you get this sort of false sense of confidence. And this is the thing that kills us. It killed me probably. I'm still trying to find a recovery. Is, when you're an asset manager, you figure you're really good at, getting, at getting the equities right, managing a portfolio correctly. And you start to get this false sense that, well, if I can manage a fund, then I know something about business, or you start to get confident in other areas of the value chain. And question yourself. I mean, I can only give you this by, like, a real story, my own story, is divorce. Okay, I'm divorced once. And, the one thing that you have to do in this world is try to find the right partner, right? Because you can make some bad career decisions, you can do all this other sort of stuff where you can eventually repair. The one decision that you do have is, is that you make a commitment with yourself, with your spouse, and maybe the powers that be, that you're going to stay with this woman for the rest of your life. Once you get divorced, and if some of you are, you can probably sympathize with this, is that you realize that you're fallible, and you realize that you're not always a good judge of character, and that there's some things that happen that you just don't know, which makes you a lot more humble in relationships. And also with asset management, once you made a couple mistakes, then you start to, I think, a lot of times that's when we see businesses built. So with that, I'll conclude.